Let me share with you gold's biggest moves in the last 100 years, and you should pay attention. Gold went from $35 to $850, from $250 to $1,900, from $1,050 to nearly $4,800. These again are gold's biggest moves in the last 100 years. These are three completely different eras, three completely different economic environments, and three completely different set of headlines and crisis and market conditions. And every single one of them was preceded by the exact same four signals, not most of the time, not in certain conditions, but every single time without exception across nearly 100 years of monetary history. And right now in 2026, all four of those signals are present. For the first time in decades, all four are flashing at the same time. Now, most people watching gold right now are treating it like a trade, something that goes up when there's fear and comes back down when things stabilize, but they're missing the entire story because gold does not just respond to fear. Gold responds to a specific set of structural conditions in the monetary system. And when those conditions align, the moves are not incremental, they are generational. And I want to show you what those four signals are and what they look like historically and why what is happening right now is a setup. Now, I'm Camila Stevenson, and around here we talk wealth. I want you to go ahead and like the video because it does help the video and the channel, and subscribe if you have not subscribed already. Now, drop in the comments if you like gold being added to your portfolio. Some people don't like it because they want an asset that's going to make a huge move. And so they're more maybe invested in silver, but I'd like to know if you are a gold holder. Now, I also want to say by the end of this video, your answer to that question may be a little different from what it is right now. So let's get into it. And I want to talk about the four signals specifically because I think most people have heard versions of this gold scenario without ever having it laid out to explain what it means for you personally and for your finances. Okay. So signal one, government debt reaches a point where it can never realistically be paid back. Right. So this is not just about the debt being large. This is about the debt reaching a threshold where the only viable path forward is to make the currency measuring it worth less over time. When you owe more than your economy can realistically generate, the options are default or inflate. Western governments do not default, they inflate. In the 1930s, after World War I, spending the U.S. debt went through the roof. So in 1934, FDR issued an executive order confiscating private gold, meaning made it illegal for Americans to own it with a fine of $10,000 or 10 years in prison, and then revalued gold from 20 to 35 an ounce overnight, a 69% gain after stealing everyone's gold. The dollar holders, of course, got nothing. In 1971, the same signal appeared again. America had been writing checks the economy could not cash. Nixon went on television on a Sunday in August, deliberately on a Sunday when nobody was paying attention, and removed the dollar from the gold standard. He called it temporary. It's been 55 years. So what happened to gold then? It went from $35 to $850, a 2,300% move. Today, U.S. national debt is 39 trillion. Debt to GDP ratio is 125%. The government is paying over $1 trillion a year just in interest, not in principal, but interest. And it's the same signal at a larger scale. Now, signal two, the rules get changed. So every time government debt hits the point of no return, the rules around money get rewritten. FDR made gold ownership illegal. Nixon removed the gold standard on a Sunday. After 2008, the Fed invented quantitative easing, specifically designed to sound technical and boring so people would not understand it was money printing. Right now, the rules are changing again. Financial repression is being activated through policy starting mid-May. And this is the mechanism that makes the government's debt cheaper while making your savings worth less in real terms. So it's the same playbook, it's just new packaging. Now, signal three, cash starts losing value in real terms. When your savings account pays you less than inflation, you're losing purchasing power every single month. Your balance may go up, but what it can buy goes down. After Nixon removed the gold standard, inflation hit 14.8%. Savings accounts paid a fraction of that. The people who held cash through the 1970s watched their purchasing power get destroyed. The people who held gold watched it go up 2,300%. Right now, rates are 3.75%. Inflation is 3%. And when Warsh cuts rates below inflation, that gap closes and cash starts losing ground consistently. It's the same signal already in motion. Now, signal 4 is central banks start buying gold. This is the most sophisticated signal and the most overlooked. The people who print the money are exchanging that money for gold. Think about what that tells you. Before Nixon removed the gold standard, France, Britain, and Switzerland were converting dollars to gold as fast as they could because they could see what the Fed was doing. They felt the vibration first and they started to move to safety. After 2008, central banks flipped from selling gold to buying it for the first time in decades. Poland, China, India, Turkey, Kazakhstan, Czech Republic, they were all diversifying away from the dollar. 15 consecutive years of buying. Goldman Sachs and JP Morgan both projected gold pushing back somewhere above 5,000 by the end of the year. The people who manage the monetary system are telling you through their actions exactly how they see this ending. The Bank of International Settlements, which is the central bank of central banks, classifies gold as the only zero counterparty risk collateral. They're not buying it as a trade. They're buying it as a foundation. So let me first address this, because you probably heard people talk about gold for years. Maybe you've been in rooms where someone explained the debt crisis and the dollar losing value and why gold is a safe haven. Maybe you heard it and thought, okay, that does make sense, but nothing ever seemed to really happen to make you really get it, okay? Because the dollar keeps going and the stock market keeps going up and gold just kind of sat there, for long stretches doing nothing much. So a lot of people don't find it interesting because most people really just want to make money fast, right? And I understand the skepticism behind not wanting to get positioned in gold. But I want to show you why this moment is structurally different from every other time that this same scenario played out. The 4 signals that we just covered have appeared together before, okay? But they have never all appeared at the same time, at the same scale that they're appearing right now while gold is already moving. Gold hit an all-time high of 5,589 or somewhere around there per ounce in January of this year. And so it was up over 40% in 12 months and up over 300% from its 2015 low. Now, again, JP Morgan is projecting that it's going to push towards 5,000 again by the end of the year. And even further along that by 2027, we'll see. Goldman Sachs called it the most aggressive central bank gold buying cycle in modern history. And that's not a prediction. That's already happening. Gold is already moving. The 4 signals are already present in that sense, right? So the question isn't about whether it's real. It's about whether you want to add this to your portfolio. I'm just laying out the signals that are flashing because there are some people who do like to hedge themselves in real money. Now, I do want to also add something that most gold conversations don't really go over, okay? And that is silver. Now let's talk about that, because if you understand the gold thesis and if you believe that the 4 signals are real and the monetary reset is in motion, then the more sophisticated position is not just gold, it's actually silver alongside gold. And here's why. The gold to silver ratio right now is historically elevated. That means silver is historically cheap relative to gold. And every single time that ratio has compressed in history, and every time silver has caught up to where it should be relative to gold, silver has outperformed gold significantly during the move, okay? So in the 1970s, gold went up 2,300%, silver went up 3,000%, all right? Same catalyst, just a bigger move with silver. In 2008 to 2011, gold roughly doubled, but silver tripled. Same cycle, just a bigger move. And here's why silver consistently outperforms. Silver is not just a monetary metal. It has 36 industrial applications: solar panels, electric vehicles, data centers, semiconductors, medical equipment. Every single technology that's being built at scale right now does require some silver. And unlike gold, which mostly sits in vaults, silver does get consumed in manufacturing processes, and most of it is never recovered, which means the above ground supply of silver is shrinking over time while industrial demand is structurally growing. So monetary demand plus industrial demand plus a 50-year price compression that no other metal experience, that is where we are with silver. And that combination has never existed before in the way it exists right now. So think about this. Silver was $30 an ounce a year ago, and currently at the time of this recording is sitting over $80. Okay, so it's up roughly around 270% in 12 months, and it's sitting right at that resistance level even now. I don't know what it'll do from this point, if it'll go down, but I do think long term silver is going to do very well. If it does close above $80, analysts are pointing to 90, 95 in the next levels. We'll see. But the fuse is absolutely lit, and the people who understand are not treating it like a trade. They are, again, treating it like structural position in a monetary transition that is already in motion. And I'll say personally, I do hold more silver than gold for this particular reason. That was my decision I made years ago. And so, but I do have both as a part of my portfolio, because I believe that gold is my anchor and silver is pretty much my leverage play on the same thesis. So I do follow gold because it kind of helps me to understand where silver is going to go. All right. So again, gold is that zero counterparty risk collateral that survives every version of the monetary reset. So it's moving right now because all four signals are present, and the institutions managing the system are quietly telling you through 15 consecutive years of buying exactly how they see this ending. And again, silver is a faster move, higher upside, more volatile. Okay. So you got to be willing to be okay with a certain percentage of a pullback without you getting scared or anything. It is more volatile, but it's the fuse that signals when the monetary transition is accelerating. And of course, I love me some XRP. It is my infrastructure bet on the new system being built. So while gold and silver exist outside the current system, XRP is being embedded into the next version of it. All right. So these are the four signals that I wanted to share with you. They do not lie. I've done some research on these and have been even following some of the experts in the gold and the silver arena. And so I wanted to share this so that you can know exactly what is happening, so that you can position yourself. I am continually buying silver, especially at this point, and I think it will do absolutely well. And I'm at the point where, I want to make sure that I hold enough real money in my portfolio. Now, here is also the thing about silver and gold that most people don't think about until, of course, the move has happened, because that's what happens. Things go up and all-time highs come, and now people are asking, should they get in? And then it starts to drop and people are asking, should they get out? Every major gold reevaluation in history has happened fast. Okay. FDR revalued it overnight. Nixon's announcement sent it on a decade-long run that most people miss the beginning of because they were still processing what had just happened. So the window between understanding the setup and the setup becoming obvious to everyone is the only window that really matters for your financial position. And so I do hold a portion of my gold and silver inside a Roth IRA through iTrust Capital alongside my XRP position. And it's not because I know the exact date that the next revaluation happens, but it's because when it does, every dollar of appreciation will stay completely mine. So I don't want a tax event triggered at the worst possible moment. I don't want to have to calculate what I owe before I can redeploy into the next opportunity. So everything that I built through understanding this thesis and this conviction will stay entirely in my hands in that account. And so I do have the gold and silver in the same account as the digital assets, the anchor and the leverage play held inside the one structure designed to protect what you build and not hand a percentage of it back. Listen, the four signals are flashing. The window is open. The structure conversation needs to happen before the move and not after. The link is in the description. There is a $100 funding bonus when you do fund the account. And coming this summer, they will be adding stocks and ETFs into that Roth account. So there is more opportunity when there are pullbacks to also buy into that. Go ahead and get your account open so that you can take advantage of things and you can be nice and situated before everything starts to happen and move. And then also, if you're wondering, how much gold should I have? How much silver should I have? How much XRP? And how does that fit into everything else that I own? Well, that specific conversation is definitely for our one-on-one clarity calls, or a conversation that we will have and we do have inside of our coaching community. And so I've been guiding a lot of my members along the way with their portfolio and how to position the right way in the right structure with adding these physical assets to their framework. Okay. So we will get you aligned, your situation, your accounts, your timeline, and build a plan for you around that understanding. All right. So the link is in the description for that. And also, again, comment and let me know, are you more for silver or are you more for gold? Everybody has different risk tolerance. So everybody's different with how they see this. Let me know your thoughts. I do read the comments, and go ahead and like the video, subscribe, and share it with someone who may not understand how to position gold and silver into their portfolio, or just someone who want to understand more about how they can set themselves up for the wealth transfer. And as always, I want you to stay wise, stay wealthy, and I'll see you in the next video.